All right. So where do you want to start?
Yeah. I just wanted to, I'm starting off and with what I initially said when I started off with the space, and now it's doubly true because we've been doing troubleshooting for 15 minutes, but bear with us. We haven't done this kind of live conversation in kind of just audio format before. So this is the first one of that, which I think if we make sure to avoid the technical issues in the future, will be something we do more in the future. So bear with us. We're going to figure out the format more, and this is going to get defined more and more through iteration. I think the obvious place to start is just start with really what we're talking about. Now, obviously, a lot of people listening, probably some of you have read the piece that I wrote already. In general, you probably, if you're interested in this kind of thing, you're following what's going on. So, some of this might be not new to, won't be new to you, but just for completion's sake, people who are just dropping in and don't might not know anything about it. Let's just start with what happened. Like and really what happened as of Wednesday or Thursday last week, a week ago.
Yeah, well, you know me. I like to do a 25-year run-up to talk about anything that happened, at breakfast. But I think maybe an interesting question to start with that is, what would you start as the first sort of causal step in this story? I'm sure you could go back to 19th century banking if you wanted. If you wanted to tell the story in a complete way, what would be the first dot point in your timeline? I had to do a version of this for two different classes yesterday, and I started with the 10-year lead up post 2008, just a sort of low interest rates regime and the aftermath of Dodd-Frank. But I don't know where you would start your story.
Yeah. Well, it's funny. Ron is briefly mentioning this big thread I did, which was talking about banking in the United States before the Civil War. And, there's a sense in which, we could go, where did this all start? It started with the Constitution and run from there. But I also, obviously, I write a lot more, much more contemporary, much more current events things as well. And in that guise, there's always a precedent, there's always an antecedent, there's always an origin story, and I'm sure we'll touch on that more. But in the kind of more immediate sense, I would literally just start it last Wednesday. Last Wednesday, there was Silicon Valley Bank. If you knew about it, you generally thought, well, it's a peculiar bank. It's serving a specific customer base in Silicon Valley, in the tech industry, among venture capitalists. But unless you were, looking through very particular kind of reports, specifically as we'll get to, hold to maturity and, looking at their balance sheet in detail, it wasn't necessarily on your radar. Oh, this bank is going to fail this week. And I don't think there was very many people who were cognizant of that, had that in their minds, with some exceptions of people who were focusing on some earlier data in January or even earlier. But anyway, so I would start just last Wednesday, because last Wednesday, there's not necessarily any public understanding that there's any public problem at all. And then in Wednesday, there's whispers, and then Thursday, it kind of starts becoming a big story, at least within a small community. So that's kind of where I would start.
And to put the players on the board, so Silicon Valley Bank is a mid-tier bank. It's $200 billion roughly in assets, and it, as Nathan said, it serves mostly a particular industry, concentration around Silicon Valley entrepreneurs. It also, importantly for this story, has at least two major payroll processing entities that bank with it, which means that in addition to small to medium-sized Silicon Valley startups and things, you also have a number of the kind of HR departments managing payroll and all of that, which means there are some real people there as well. And my understanding is that in addition, the Silicon Valley Bank kind of profile included providing kind of concierge and personalized banking services for a lot of the CEOs and founders of these startups, which is somewhat unusual in that it was offering, on one hand, just general banking services, accounts and payments and all that kind of stuff to these entities. On the other, it was offering loans, sort of traditional business loans and things, on the condition that you kept your deposits with them, which is not necessarily common either. That sort of everyone who was a borrower was also holding. It was also banking with them, and then it also had the sort of executives personally banking with them. So it was a very kind of contained affair with its customer base, focused narrowly on one industry. And I've seen people make the analogy to credit unions. Obviously a very different structure, very different kind of consumer base, but in the sense that it had a lot of exposure to a particular industry, particular group of actors, particular set of forces that was not particular. It was not diversified to others. And then, especially when it came to the size of those accounts, because they were mostly businesses, there weren't that many mom and pop depositors, and that the individuals who were banking with them were also sort of wealthier actors. That I think it was over 90%, 93%, 97%, I think the exact number, of their deposits were uninsured deposits. That is to say, existing above the deposit insurance cap that the FDIC guarantees up to $250,000. So you have a concentrated industry. You have both the firms and the founders, CEOs, and the payroll. You have a lot of high denomination accounts that are outside the traditional FDIC protection. Anything else to sort of say about Silicon Valley Bank specifically?
I think the one thing to say is that it's not just that it had a lot of uninsured accounts, but specifically over a very short period of time, because of the boom in the tech industry, a lot of venture capital rounds and so on. The amount of large denomination deposits increased rapidly. So it goes for something where it was already very high, like 75, 80%, 84%, something like that. I don't remember exactly the stat offhand. With that growth goes to 94% of the deposits being uninsured, which is really basically it's like basically the FDIC deposits at that point. Insured deposits are basically bupkis, which is very. There are a couple banks that are like in the 70-80% range, but that is an outlier even among banks that have a very large amount of uninsured depositors. And it happened in a very quick. This change and expansion happened over a very short period. So there was, there was like a rapid adjustment of how it was going to manage its balance sheet. And the obvious thing, you have liabilities. You have this huge increase in liabilities. You have assets, but the assets are just money and in their checking account at the Federal Reserve, and that's all very nice. But the big problem with money in your checking account at the Federal Reserve is, it may pay some interest, but there is an interest in earning a higher return and getting in actually earning a significant spread from the cost of your liabilities to your assets, and we'll get into this more, but to get that spread, to get that higher return while still notionally holding on to safe assets, they bought longer and longer maturity securities that were notionally low risk, into the sense of low default risk, and whether consciously, unconsciously, not really thinking through, or not managing this element of risk, took on a lot of interest rate risk in order to goose returns.
Yeah, interest rate risk being the risk that when interest rates go up, you may not be able to, you'll lose value because there'll be other assets that are relatively more valuable that you could be investing in, or if you try to sell them, they're relatively less valuable because they're earning lower rates. Also, duration risk there. But I think to your point, it's important to note that there are other banks whose business model is primarily on the loan side, right? You're trying to make loans every day, and in doing so, you attract depositors. It's a cheaper source of funding than borrowing from the other banks or from the discount window when you need liquidity. But this was almost a deposit outwards business model, right? Get the funds, hold the funds, and then find a place to put them, rather than do the lending first and then attract depositors for whatever set of reasons. Yeah. So the fact that it was growing very quickly was also combined with the fact that this wasn't a bank who was starting with looking out at the landscape and seeing a bunch of sort of very good consumer loans or business loans that it wanted to make. It was primarily holding funds for actors and then trying to work out how to make sure that they were dealing with a decent yield on the funds that they held in backstopping those liabilities.
The other important thing to make a point about that is it's one thing to have interest rate risk in the sense of your assets, if you sold them today, are less valuable because interest rates have risen, and you could have, if you held the settlement balances, then you could have bought a bond paying a higher amount of interest at that point. But that's kind of an unfortunate thing. But and this is kind of the initial logic of the idea of hold to maturity, is if the cost of your liabilities don't rise, then you're still getting the return. In fact, you're getting the same return that you were getting before. It's just that return now doesn't look anywhere near as good now that interest rates are a lot higher. The danger that comes in is the danger of increasing the cost of your liabilities. That's when you start taking losses, and there is an industry standard, and if you try to keep interest rates on your deposits too low, especially these large denomination deposits in actors that can make a decision on the fly and are going to think more strategically than, say, small depositors, especially insured small depositors. There's a risk there, but even still, and this is what we'll really get into what was really the crisis. Even if you are taking losses, the losses even if you take losses from the cost of your liabilities rising, those losses will be limited and spread out over time. If you still have, if there's no outflows that you need to cover, and on the flip side, you can still hold those securities that you hold. You're taking losses, but it's slower. And hey, if you're taking losses slowly, then you can try to figure out something. As we'll get into, what happened was they suddenly felt like they had to take losses very quickly, and they were in a sudden squeeze of a funding issue all at once. And because the funding issue was mixed in with this question of losses, the ultimate resolution ended up being just the FDIC and the state authority taking over the bank on Friday morning.
Yeah, so maybe a few more terms to just define. So First of all, hold to maturity is a way of valuing your assets, right? It's a way of putting a number on your balance sheet that your auditors, that your accountants will say, okay, this is a legally sound number to value this asset. And hold to maturity just means if I was to hold a 30-year bond for 30 years when I get the full face value, etc., this is how much I would get. This is how I can value it. The other way that a lot of assets are also valued is called mark to market, which is at the end of the day or end of a period, whatever the current prevailing market price is, that's the price you have to assess it at, right? So you buy a car, it costs you $20,000. 2 days later, it's secondhand. The market value is $15,000. You have to put that as a $15,000 car instead of a $20,000 car, versus getting to hold it and calling it something that you put $20,000 in for as long as you can. And so you buy up all these bonds, right? People deposit all their funds with you. You don't have any existing assets that you were trying to expand, right? No loans you were trying to expand. So you take the funds that people deposit, you buy up treasury bonds, and as long as you get to hold them for the 30-year period, or as long as you get to sell them at a good time, you're okay. And to Nathan's point, when your deposits have to pay more interest, then they start to look relatively less attractive. If a bond is only 3%, you have to pay 5% to your depositors. That's something you don't want to be holding. The other thing is, when interest rates rise in general, then the bonds that you are holding become relatively less attractive to everybody else, right? You buy a 30-year bond, you hold it for 10 years, it's functionally at that point a 20-year bond. But if you bought it when interest rates were 3% on 30-year bonds, and now the rate on 20-year bonds is 5%, why would anybody buy yours when they could go and buy a fresh one, right? Why would they want the lower yield? So yours is going to be relatively less valuable than other 20-year bonds out there at the time. So these actors that are holding these 30-year bonds, they bought them when it seemed like a good idea. When interest rates rise, they became relatively less attractive, which means not only is it hurtful for them to keep holding them, but nobody else is necessarily that interested in buying them when they can buy others that earn more interest. So as Nathan said, as long as you don't actually need to sell them, you could theoretically hold them until they mature, right? So why did they need to sell them? What was the crisis moment that caused Silicon Valley Bank to suddenly need to sell off a bunch of these bonds?
The crisis moment, and we'll get back to this because there is an open question, which we'll talk more about the discount window and such, of did they actually need to suddenly start selling bonds and taking huge losses immediately? But we'll return to that in a second. The thing that they needed to do was to find funding to replace the funding that they were losing. The funding that they were losing was that concerns about the bank had proliferated, and there's apparently 100-person, 200-person group chats reportedly. Some people have discussed openly their participation in those group chats where venture capitalists talk to each other, and concerns about the bank emerged very quickly. And when you have a group of people who all have large amounts of money in this bank, that they hold huge amounts of uninsured deposits, and the thinking is a kind of fear thinking, rather than a sort of let's kind of have a collective stewardship of this institution that we rely on in all these other different ways. What happened was essentially like the perfect storm for what's known as a bank run, which means it's when every creditor who has the ability to cash in their liability, or technically has the legal right to cash in their liability, get a payment sent to some other bank. Obviously physical cash is the traditional notion of this, but that's very hard to do with such large denominations, and not practical. In practical terms, what a bank run in this circumstance means transferring means opening a deposit account somewhere else and transferring your funds there. So that's what happened, and it happened all at once. It happened much faster than it could, with a telegram wire in 1927, or word of mouth going just within a community. It happened at the lightning speed of the internet, of Signal, of a group chat, and they all went to go transfer their funds at once. And when you have that, when you deal with payment outflows over time, there's things you can do. You can find alternative sources of funding. You can, maybe raise the interest rate on a deposit to attract depositors. There's things there's basic parts of liability management that banks do all the time. And of course, there are some liquid assets that they'll also sell as well. Usually ones that have been booked as available for sale. But this was the perfect storm of having mostly uninsured depositors who all were talking to each other, and basically, a contagion emerged between them to, oh shit, we all have to get our money out. And they did. They all tried to get their money out once, and that's not something that a bank, even a bank today, can manage given our current institutional structure. And we can get back to that much down the line, but that's not something that can be managed. Bank runs still are a thing, especially when you have mostly uninsured depositors, which is very unique, but is applicable in this circumstance, in this scenario, among this bank, maybe a few other regional banks. Of course, we'll get into that question of systemic risk and so on. And so that's what happened. And they had to respond, and they decided to respond by trying to sell a whole bunch of securities, but that just made things worse because they started just realizing the losses that were up to that point unrealized. Realizing mean, hey, interest rates could go back down, which ironically they're going back down right now. And so you can sell at a lower price, or, the interest rate can go back down on your liabilities. So, you're taking less of a loss each time. Like, there's things that you can do before when you haven't realized losses. But once you sell, the loss is locked in. You've taken that loss forever. And they started rapidly locking in losses to try to get liquidity, to try to cover these payment outflows, and that just made the run worse if it hadn't just already inevitably go in the direction that it was going in, and still, because they were taking huge losses, was not enough to cover the outflow that they were experiencing. And when you have big concerns about your profitability, when you're realizing huge losses, and at the same time you're having funding difficulties, that's a classic moment where regulators step in and the Federal Deposit Insurance Corporation takes over a bank.
Yeah, I mean, if that prehistory of the rapid growth, maybe the phrase is, well, that escalated quickly, and then what happens here is life coming at you fast, and once you're locked in that doom spiral, it's sort of all over unless there's some external Hail Mary. And I think probably worth noting here, given that we've blamed the bank and its business model, we've blamed the depositors and the clients for their mass coordinated exodus. I saw one article saying this was the first bank run organized via Slack, and I saw another one saying this was the first bank run on Twitter, and I'm not sure which platform wants to fight for the enviable record of being the platform upon which the bank run was organized, but it's simultaneously something to be proud of and something to maybe not be proud of. But I think it's probably also worth noting at this point that the reason this even happens in the first place is to do with the regulatory treatment of the bonds themselves, right? So the bonds were 30-year bonds, and that doesn't mean that most people hold 30-year bonds for 30 years, right? A lot of people will hold these and sell them when they need to on the market, or if not on the market, sell them to the Federal Reserve. And so in that respect, even though they are called 30-year bonds, they are liquid, or at least more liquid than some things. They can be sold for cash when you need to, but you take some sort of haircut. You take some sort of discount. You don't get the full face values if you held it for 30 years. And relative to shorter maturity instruments, you may take a larger haircut if you need to sell them today. So compared to the most liquid of all, which would be overnight reserves at the Fed, right? Then the most common form of collateral in the money markets, the most sort of liquid, is the 3-month Treasury bill, and then you go up 6 months, 12 months, whatever, all the way up to 30 years. And in this situation, a lot of them were holding on to longer term bonds. How are they holding on to all these longer term bonds, not thinking they might ever need to sell them? That's an important question. Why did they think they could stuff their balance sheet with long-dated assets and not one day find themselves in a position of needing to sell a lot of them? Well, that's a big question a lot of people are asking right now. Didn't they know that this was going to be a problem when interest rates were increasing? Couldn't they see all the way back in 2021 that there were going to be interest rate increases probably coming, given that inflation was higher, etc.? And that's how the Fed thinks it needs to respond to higher inflation, is by raising interest rates. So this was a foreseeable problem. In fact, this is a foreseeable part of general banking risk management. But putting aside that management failure for a second, the other big problem is that the regulators had approved a change to the liquidity requirements that said banks were eligible to treat these bonds as having their face value, their held to maturity value, rather than their mark to market value, and to consider them as part of a category of what is called high quality liquid assets, which normally you're thinking about reserves and T-bills and things like that. But in this context, these 30-year bonds were allowed to be considered as a safe asset because they are ultimately backstopped by the full faith and credit of the government, even if you sort of have to ignore the maturity and interest rate risk along the way. But they were allowed to basically treat them as equivalent to short-term instruments for regulatory purposes. And this created a kind of, as far as I can see, an almost impossibly alluring, dangerous, poison chalice for them, which is, if I could store my money in something earning more interest and get to call it the same category as something that I would normally store it in that earns less interest, well, why would I leave money on the table? Why would I be why would I not want to get that higher yield and not have to worry that it's going to show up on my balance sheet anyway? And to your point earlier, Nathan, that nobody even knew this was coming until Wednesday, Thursday, I believe there's a lawsuit right now that has been initiated by the shareholders of the bank saying that the directors of the bank committed fraud, securities fraud, by not mentioning this in any of their kind of recent public statements about the health of their company, health of their bank. So one of the questions is, even if you didn't know where to look, maybe there was a responsibility to actually affirmatively disclose this under sort of securities disclosure requirements. Now, whether or not that lawsuit is going to succeed remains to be seen. I'm not particularly hopeful, but the fact that they're even bringing it suggests that this is sort of part of the story too, which is even if individuals didn't know they should be looking for this, the people who are running it, even if they thought it was okay, probably should have actually let people know, let investors know and things, that this is what was a risk kind of coming down the pipeline. But part of the reason this could even be a risk in the first place is because of that regulatory change that said, yes, we will allow you not only to hold these bonds as liquid assets, but also value them as if you never had to sell them, even though it's quite foreseeable that you might need to sell them.
Yeah, I would say on the lawsuit thing, I mean, the thing about the lawsuit is, while, if you look at the balance sheet, hey, look, the capital levels are great, as long as you treat the securities as hold to maturity. The footnotes do disclose that they've taken these huge unrealized losses. You do a little math, and the unrealized loss, you'd see the unrealized losses are almost, equal to their entire capital. So
it was about $2 billion from memory, something like
that.
Yeah. There was a gaping hole in their balance sheet stuffed into a footnote of $2 billion.
Yeah, I mean, on one hand, you can say, I mean, there should be a big flashing sign, but the other thing is, it's kind of it's the idea of a disclosure being a big flashing red sign when the disclosure is the bank, if it realized its unrealized losses would, wipe out its capital. I'm not sure that that disclosure requirements are such an extent where you not just disclose it technically, but you're supposed to say, the bank's failing. I mean, at that point, why not just go to the FDIC and say, you need to put us into receivership?
Yeah, we cooked. Wave the white flag on Monday rather than wait until Wednesday. Yeah, I mean, it's sort of like someone goes on a date and they say, what's your biggest weakness? So you go to a job interview and they say, what's your biggest fail? You don't actually say your biggest failing. If you said that thing out loud, you'd probably be, arrested or something, depending on who you are. So
I will not be able to do this job, and I will not work an hour of it, and I will immediately, as soon as you hire me,
take a bunch of your money and make you regret it. Yeah. So you say something like, my problem is that I work too hard, and then you put in a footnote, what the real problem is. So there's an element of all of that, which is part of why I don't think that the lawsuit is looking particularly promising. But there is an extent to which it wasn't like nobody could see this coming. There were people in a position who should have been able to do the basic risk assessment, and in fact, part of the reason why that coordinated exodus happened was because they were paying attention and started to see that this was coming and figured, let's get out first. One of the quintessential dynamics of a bank run is you don't want to be the last sucker in line, right? The thing about a bank run is it looks like it's terrible, but it's mostly terrible for the people at the back of the queue, right? Bread lines work until you run out of bread. So this is a situation where once everybody realized that this was pending, the only relevant question became, how can me and mine coordinate effectively to make sure that we all get out and somebody else is left holding the bag? And that's why you end up needing these carefully coordinated Slack channels and things like that, is to coordinate the timing of the exodus so that you don't start it until everybody's ready to go at once. So there are a couple things there. One is, and we'll maybe talk about this a little bit more later, but to me, it's still an open question. Where were the supervisors here? Because a lot of this stuff seemed very obvious. Obviously, I wasn't going through, that's not the kind of thing I do, at least not right now, is go through the, major banks, medium-sized banks, and look at the
look at their disclosures, look at their financial reporting and see what's going on there. But, and so there's always an element of like, well, in retrospect, but nonetheless, that incredible Financial Times chart of, if the unrealized losses were realized, how are these banks doing? Just that information alone tells you, there's a huge problem going on with this bank, and it should have, if it shouldn't have been, warned about in advance and pushed for taking interest rate risk more to consideration and match their duration issues. Duration being a term for, the difference between maturity of liabilities and maturity of assets. Beyond that, I mean, they should at a certain point know, well, this if they realize all this losses, they'd be completely toast. And that definitely should have been more conversation. That I think we're just going to need more reporting to see, they're doing an internal review. Federal Reserve internal reviews do not have the best history. And I'm sure we'll also have congressional hearings. So I'm sure more of this will come out.
I'm hearing calls for an independent review and things like that, recognizing that the Fed reviews are not often good. And, I'd love you to do more work, Nathan. I'd love you to get off your ass and actually be productive for a change. But I think you can be forgiven. I think you can be forgiven for not taking responsibility for individually examining every medium-sized bank's balance sheet, especially when there are bank examiners who get paid to do this. And, of course, it's important to note here, when we say bank examiners, we're not talking about someone who sort of sends out a form with a questionnaire once a year. You're talking about a $200 billion bank. There are probably supervisors and examiners who are either on site permanently or near permanently or have very, very ongoing relationships or some combination of both. And so you're talking about people whose day job would be kind of almost exclusively focusing on this particular bank and its balance sheet and health. And this is a sort of pretty glaring issue. It's like you have a primary physician and you're going in there every single day and it turns out you have a huge abscess on your face and they just didn't bother to bring it up to you until it, metastasizes or something. It's like, what is your job? What is your job if not to catch this exact kind of thing, especially given that this isn't 7 layers of complex derivative products or anything like this. This is actually quite a simple bank a balance sheet, and it's quite a simple problem, which is they are bonds that if you look outside the window, the ticker price says it's worth X, and the accounting is saying it's worth Y. And even if you're allowed to say it's worth Y because of the existing rules, you have to be aware that there's a pretty big mismatch between those two things, and that might have implications.
Yeah, interest rate risk is the bread and butter of banking. It's the bread and butter of banking for at least 100 years, if not more. So the idea that interest rate risk is not like literally your first question before you get to anything else is preposterous. I do want to touch on something you were talking about before, and I think
one note on that, which is just, we're not talking about complex products, right? We're not talking about very convoluted derivatives. We're talking about one of the most bread and butter instruments. So not only is interest rate risk so important and so fundamental, but treasury bonds are pretty fundamental. If you cannot price or understand the pricing of a 30-year bond, what are you doing?
I mean, this is 1950s Fed Treasury Accord stuff. It's not, rocket science. Which is kind of related, but I just want to touch on it, but sort of just like put a bookmark in it because I think we need to have an entire conversation just on this topic. You brought up liquidity coverage ratios and the question of should long maturity of assets been treated as part of high quality liquid assets as part of the liquidity coverage ratios or count for liquidity coverage ratios. I think that's a huge issue, a huge topic that's really important for us to get into, which I think is much bigger and obviously related to this situation, but is like much more profound in terms of other issues that we've talked about how monetary policy is implemented. And I think it's beyond the scope of what we're talking about here, but it's so important, because, the obvious issue with saying, well, long maturity treasury securities shouldn't have counted is then the universe of securities that would, or just instruments in general, securities and balances in your checking account at the Federal Reserve, settlement balances. The issue there is that universe becomes so much smaller, and then there's already been issues in terms of having sufficient high quality liquid assets. The amount of short maturity treasuries that would need to be issued to cover that is huge, and we already before that have had shortages of short maturity treasury securities, and you would need kind of really a whole other apparatus to deal with that, which gets to a lot of issues that we've talked about before about Federal Reserve securities, and a lot of stuff around 2008 and 2009. And as I'm describing it, you can see this is a huge scope issue, and I just want to put a pin in that this is an important thing that we need to go back to and kind of have a whole discussion about.
Yeah, I when I teach first year contracts, and it's sort of a potted attempt at legal history masquerading as a doctrinal subject, which is how most of the first year law curriculum works. I always kind of make an emphasis of that Vonnegut line that I think it's Vonnegut, that the past is not over, it's not even past. But the other line that I like about that is the futurist Alvin Toffler, who says the future is already here, it's just unevenly distributed. But when you're thinking about treasury bonds, it's almost like saying, well, turns out 30 years in the future is actually here today too, just under slightly different circumstances, but you all aren't ready for that conversation, But I think it's a moment when one of the people who talked a lot back in 2011, 2010, around the last big financial crisis, about the problem of a shortage of safe assets was Mr. Shadow Banking himself, Zoltan Pozsar. And he's been sort of notably absent in this crisis. And I was sort of wondering, and I heard a few other people saying, where's Zoltan in all of this? Where's his big note? And then, of course, today we're finding out that there are also serious problems in Credit Suisse, where Zoltan has been working right now. So I think maybe he could be forgiven for being otherwas preoccupied.
It would be the biggest of ironies if Credit Suisse goes down with Zoltan right in the middle of so many of Zoltan's core issues going on.
Yeah, it is.
But I don't want to speculate more about that and about the motivation. But I think it's a very fair point, and I do hope to hear from him, soon when things are less acute.
Yeah, I mean, pour one out for him, pour one out for Credit Suisse. But I think more importantly, just the ghost of Zoltan Pozsar's analysis circa 2011 about the shortage of safe assets being a serious problem for the drive of shadow banking is in the background here, right? As to Nathan's point, if we did try to actually address this gaping kind of logical hole in the fact that we're treating 30-year bonds as short term, then you would probably need to get into all of that pretty quickly. And the only other thing to note on that is one of the ways that this is less of a problem is when the Federal Reserve, when those secondary market backstops are allowing you to sell 30-year bonds at relatively good prices, right? The Fed is backstopping that market, not necessarily with a direct price guarantee like they do with the overnight rate, like they do with short-term treasuries, but with the sort of implicit or at least semi-supported roll through something like quantitative easing. In Japan, they just literally say the rate on 10-year bonds is X, and it stays there. Nobody bothers trading them because you don't need to. You just go straight to the Bank of Japan. But the Fed has not made it explicit like that. They've made it implicit or indirect by buying a lot of them. But that meant that there was still at least a fair bit of government support for those rates. But in recent years, the Fed has been moving towards shrinking its balance sheet in addition to raising rates, which people often consider sort of conflate the two, but they are separate. And so what you had was a situation where there wasn't as much sort of stable guaranteed buying demand for these at a sort of stable price. So to the extent that there may have actually been different conditions in the past that meant selling 30-year bonds was not going to cause you as much of a haircut, those conditions were changing at the direction of the Fed. And unlike raising rates, which is about dealing with inflation, at least in theory, the decision not to continue buying as many long-term bonds as it had been buying for years and years and years was largely justified on the idea that the Fed doesn't like having a big balance sheet. It wanted to sort of slim down, right? Losing a few pounds in time for summer. And that idea had very little economic justification. It was entirely about the politics of the Fed's balance sheet. When it's too large, the policymakers kind of pay too much attention to the Fed, and it doesn't like that. So in the name of helping the Fed feel a little bit better about itself, we had a sell-off of long-term bonds that made this whole process a little bit more vulnerable, I would say.
Yeah. Although, it's interesting. I can't resist commenting on this part, even though it's about the issue that I just wanted to bookmark. If you were to do a regulatory treatment where only short maturity treasuries counted as high quality liquid assets, then the holding or selling of long maturity treasuries by the Fed, and that's what a lot of what their balance sheet is filled with, mostly, would be neither here nor there in terms of meeting liquidity coverage ratio requirements, because it would just not count either way, or maybe if it counted in a discounted way, but if you didn't count it at all, then it would be neither here nor there in terms of meeting these much larger liquidity requirements. So that's also another thing we have to think through in terms of monetary policy implementation. And we have our alternative proposals, which would give the Federal Reserve much more control over the yield curve, over the quantities and interest rates across the scope of the securities that they issue. But that's another topic.
Yeah, when is a 30-year bond not 30 years? When is a liquid instrument not liquid? When does safety not actually guarantee safety? I mean, these are all philosophical questions that you could, smoke a pipe and stay up all night talking about. But I think actually do undergird the acute crisis that we saw here. The other thing I want to maybe bring out, just one more contextual point before we go into the sort of aftermath implications, is this bank failed, but we could look back 2 weeks and see the failure of Silvergate. And then after this, we've seen other banks, First Republic and Signature. And a lot of these, but not First Republic, but the other two are also kind of heavily involved with the crypto world. And one of the clients that Silicon Valley Bank had was Circle, USDC issuer, the stablecoin issuer, that has claimed for a very long time that all of its funds were backed by cash or short-term treasuries. Now, when you hear those words together, there's a reason they say short-term there, which is exactly what we're just talking about. It's the recognition that long-term treasuries are not in fact as safe and liquid as short-term treasuries. So they were saying for a very long time that all of their funds were in a safe place and a liquid place. And then it turns out that they were exposed to the tunes of billions of dollars to the Silicon Valley Bank and were holding uninsured deposits. So this is not only a problem of the bank itself and its internal balance sheet, it actually indirectly becomes a problem for Circle, which depegged briefly, went down. The USDC coin was not trading at par anymore. It was trading at a pretty big discount. It sort of recovered after the news of the bailout or the bail-in of Silicon Valley, where those uninsured deposits were effectively ex post guaranteed by the government. But it was a great example of the kinds of risks that we've been talking about for years and got a lot of flack from the crypto community. That simply saying, well, we're a money transmitter, we store our funds at a bank or in safe assets, is all good. That's good enough. And we've been saying for a very long time that this focus in general in the debate over stable coins and money transmitters on the asset backing of the liabilities. You issue a stable coin liability, you say, well, don't worry, we've got 100% assets somewhere, whether it's treasuries or bank money, was always a kind of misguided approach to safety. Unless you have an explicit government guarantee, unless you have the equivalent of deposit insurance, like a bank, you are always vulnerable to either a sort of mischaracterization of those assets or some other intermediary risk, some other problem that could go on. And what we are seeing now is exactly the kind of systemic problem that we were saying that Circle was going to be vulnerable to. So this is a great, kind of, it's like Stefan from Saturday Night Live. This crisis has everything. It has not only banking and deposit insurance and long-term bonds and interest rates and things like that, but it also has Silicon Valley and it also has crypto. And there is this sort of conspiracy theory emerging, and maybe it's got some 5% grain of truth too, that a lot of this was also about trying to really put the screws on crypto, and that Silvergate was the crypto bank. It was the bank that almost every crypto project in the United States was banking with, that needed a bank account precisely because they were willing to work with crypto in a way that a lot of other banks weren't. And Signature Bank was also working with a number of them. And there was a quote earlier that Barney Frank put out saying, "Oh, they shut us down even when they didn't need to, because they shut down the other two banks that worked with crypto actors, and they figured they could get all of them in one go." And he actually walked back that statement in the same interview, but by that point, the crypto community picked up on it to cry victim. And it's ironic, of course, that it's Barney Frank who just did an interview saying, "Yeah, look, I need to make money." And also ironic that Barney Frank was one of the few members of Congress that openly refused to have a congressional pension, saying, "I'm not married and I won't need it on the other side." And then now saying, "Yeah, I work at a bank. I needed to make money." Well, yeah, man, nice to know you thought you were better than your public pension, and that's why you needed to sell out on the back end. But the fact that these three banks are three of the four that are currently being discussed as the sort of epicenter of this larger issue is interesting to me, because they have quite different profiles. The Silicon Valley Bank was kind of unique in its customer base and its major focus. But I would have assumed that question of the bonds and the high quality liquid asset categorization would actually be the more vulnerable systemic point. If you'd said to me, on Friday or Saturday, what's the risk that this sort of extends outwards from here, I would have probably said, well, any bank that used the same accounting treatment for long-term bonds could face a run as well for similar reasons. But that doesn't seem to have happened as much.
Yeah. I mean, partly it's just the uniqueness of Silicon Valley Bank's unrealized losses is just, it's just so huge. With Credit Suisse possibly notwithstanding, I will cop to. I've been so busy with so much stuff in Silicon Valley Bank, I have not gotten to Credit Suisse, and I don't think I will get to Credit Suisse until maybe even 2 weeks from now, and maybe there won't be a Credit Suisse to get to, and I'll be just dissecting. But we'll see about that.
When Switzerland becomes a real country, we'll treat its banking crisis like a real banking crisis. But until then, we'll focus on places where there are real people. Goat herders,
You have so much American chauvinism, and you're not even American.
I think everyone's allowed anti-Swiss chauvinism. That's until they don't get the central bank swap.
Fair enough. Just remember, you're talking about Australia. Like keep it in perspective here.
Look, I left there too. All right, I'm not defending Australia, but there is a sense in which Switzerland is a bunch of banks with a few mountains attached, and it is interesting that Credit Suisse of all banks is facing this vulnerability right now. But to the extent that we saw credit spreads and things increase on the back of this, even after the government declared its bailout, I sort of was quite shocked at how aggressive the response was. I sort of said to my students, normally you see this kind of crisis play out over a period of months. Usually there's a lot of real people, real economic pain elsewhere, and the banking part of it becomes, paragraph 3 in a larger piece, and a lot of people are so focused on all the real pain that the kind of explicit focus on its implications for the financial system kind of happens later when some of the dust settles, and often happens after the media cycle is getting tired of the acute details. But we had this very kind of tempest in a teacup weekend where it was very hyper focused on one institution, maybe three if you spread out a little bit, and the response was extremely quick, and it was an extremely aggressive response. Right, we're going to guarantee all of these deposits by the FDIC, something that has always happened or happened quite regularly de facto with big banks and medium-sized banks, but now is sort of happening quite explicitly in a way that feels to me like it's going to be hard to put that genie back in the bottle. Now that it's clear that this can happen, it's hard to believe that it couldn't happen again. There's nothing unique about this crisis, and while the balance sheet of Silicon Valley Bank was relatively unique, it doesn't mean that there aren't other banks that might have similar problems that would need similar bailouts. And so what we are seeing now is any possible problem like this could be resolved the same way. And I think that's the kind of existential and ideological crisis moment for a lot of our fellow banking experts that don't see things the way that we do, to say, oh my God, they can do this? They're going to do this? They could do this again?
Well,
you know, this is a pretty crisis of faith moment for a lot of them,
yeah.
I would say.
And you know, in fairness to those banking experts, there was a whole episode that was basically like this, that we had, you know, where we're coming close to the 40th anniversary of, and then was reinforced in through, you know, the long, very drawn out savings and loan crisis, where it's, you know, called Continental Illinois Bank failed in 1984, and the FDIC stepped in for these similar, you know, kind of systemic risk reasons, and covered every uninsured depositor 100%. And it was, you know, at the time it was a very big bank. Now it seems like bupkis, but at the time it was a relatively large bank, not the biggest bank, but like, you know, I think in the top 15 or something like that. And the key to that was, well, you know, and of course the Fed was huge about wanting to, you know, deal with the systemic issues. But of course, covering all those deposits meant more coming from the FDIC. And, you know, that was one crossroads that was similar to our crossroads, but in the context of the Reagan era, the Bush era, the H.W. Bush, early Clinton era, but especially, you know, the Reagan-Bush era, they saw the same thing. Well, there's one direction we could go, full deposit insurance, a much tighter regulation. Well, where are Reaganites going to go? They're not going to go in that direction. And then there was another direction, which is, let's really try to make uninsured depositors eat it as much as possible, or as much is consistent, quote unquote, with financial stability or some degree of financial stability. And so one of the changes that happened, you know, I believe it's in 1990, in this reform of the FDIC, is this least cost rule. You know, the FDIC Improvement Act, and the least cost rule was essentially that they have to try to resolve a bank without having to place funds to cover deposits. You know, essentially, you know, some fund would come out of the Treasury, you know, when you know, gets deposited in some new bank's checking account, or some bank that has bought the other bank, or simply, you know, is provided to the depositor in whatever they say is their new bank account, whatever the case may be, which is supposed to, quote unquote, cover those funds. And the more you send out, the more, you know, quote unquote, public money is involved. And of course, we'll touch on that issue in I'm sure later on. And but the key when I'm driving at here is, you know, if you're a traditional banking expert and you look at this experience with the mid 1980s, the early 90s, well, the viewpoint up until the recently, with obviously the complication of too big to fail in 2008 and all that, was, well, we resolved this. You know, uninsured depositors are going to eat it a lot of time, and a number of banks have failed. And it's been mostly smaller banks where there's been significant hits to uninsured depositors. Some only like a few percent, but some losing as much as 50% or more of the value of their deposit. So looking at from that perspective, you'd think, well, we have least cost resolution. And if you follow the debate among, you know, us, other banking experts on either side of kind of this big line that is come into focus the last week, but of course we've been focusing on for a while, regardless of what perspective you took, just on the law, it seemed like there wasn't much like it. Not sorry. Let me put this more precisely. There was a lot of doubt that that the Biden administration was actually going to cover all these deposits, cover all these uninsured deposits 100% on the dollar, precisely because of the least cost rule. That following the least cost rule, which has been followed in hundreds of banks, and I think mostly small ones, but some seem relatively significantly sized. And the exemption is basically there's the systemic risk exemption, and it was obviously we're in a situation where they've made the systemic risk case, and there's not uniform, but a lot of people are accepting that this was truly a systemic risk. But it certainly was debatable and very unclear on Saturday whether this really could count as a systemic risk. And this is a new world. If you're the traditional banking expert, what's new about this, what's unique, what's shocking, and in some sense shocking to anyone, is the standard for what systemic risk has fallen quite a lot. And this is why people think we have effectively gone back to some kind of informal full deposit insurance system, is precisely because they cover deposits in full in precisely the way they did with Continental Illinois, and the rules that were put in place to prevent doing something like Continental Illinois, or were thought that they would prevent something like Continental Illinois and covering all the uninsured depositors fully, have basically become a dead letter. It's unclear, it's unclear whether the least cost rule really ever be applied again. And it's possible it will be only applied to small banks, but that's very unsatisfying. It's one thing, and I think, for us, it's a huge problem. And, we already kind of think, hey, we should have been doing unlimited deposit insurance years and years ago, too big to fail, all that. But it's one thing to be 4 or 5 banks where there's de facto this idea that those banks won't be allowed to fail. Uninsured depositors will always get covered. But now there's the open question of, well, is it going to be medium-sized banks are going to be covered? And, the law hasn't formally changed. We haven't actually passed a new statute. So you're still seeing some outflow from medium-sized banks to the too big to fail banks. But fundamentally, the whole legal structure of how the FDIC was reformed and how this is, quote unquote, supposed to now work has fallen aground. And that's why everyone is so shocked. And that's, even people who have a kind of, a view of, which we can get into, of banking as being kind of inherently public in nature, coming through an allocation of some public power. That's why everyone is kind of taken aback by this, because this crisis has put uninsured deposits on the table, and the crisis or the situation, the panic, whatever you want to call it, was resolved in a way that suggests a full break with that legal tradition, with that reform tradition that happened in the aftermath of the Sallie loan crisis and Continental Illinois, which eliminated, which tried to pull back and keep the system of uninsured depositors being seen as some sort of private regulation of the financial system, as opposed to simply just relying on public regulation. Anyway,
all right. Okay, I'll walk back my death penalty prosecution of our fellow banking experts to life imprisonment for missing the forest for the trees. But a couple of points there. First of all, the least cost rule, which comes out, when did it come out? Early 90s is my memory. Correct me if I'm wrong.
91. Yeah.
Thank you.
I looked up 91.
Right, and I think it makes sense to defend its significance to this story, but I think it's also worth condemning its merit as a rule. A word like least cost sounds like it makes a lot of sense, but what you're often doing, and you see this all over the place in public policy, in an attempt to save a dime, you spend $1. In an attempt to avoid the most obvious direct way to solve the problem, you create a whole complicated Rube Goldberg system, right? What does it mean to directly bail these out or directly guarantee? Well, you put up public money first. What does it mean when you try to do this least cost process? Well, you go to receivership and you try to prime private actors and try to make sure that there's some assessment that goes on banks that captures all of the cost up front, etc. And the next thing you know, you have this convoluted system that gives the impression that we could never possibly spend a dollar, that there's definitely no government subsidies going on at all on a regular basis, and that these sort of private insurance models are internally coherent and sufficient. So I think that least cost thing is dead letter is a positive development in my view.
Yeah.
And to your point about the fact that there were a number of failures, I've been pretty flippant about the existence of those failures, and there are enough of them to be a real thing. But the other point to note about that is that they are often very small banks, and it's not one exception that proves the rule. It's 500 exceptions that proves the rule. But the rule is systemically uninsured deposits get bailed out. Right? If you nibble at the edges, you lose one little bank here and one little bank there, it's not actually threatening the very idea of an uninsured deposit. But this crisis at a mid-sized bank that also was based around in part, this regulatory classification of high-quality liquid assets that a number of other banks were also adopting or using or exploiting, meant that anybody could have a run similar to this at a medium-sized bank, and that uninsured deposit category, that entire instrument category, was now being thrown into relief. And that's the moment, in my opinion, where even since the 80s, we haven't seen any real serious attempt of saying, yeah, look, uninsured deposits, are important source of market discipline. If people invest in uninsured deposits and they don't do a proper safety and soundness assessment of the bank, they deserve to get wiped out. You can say that about a mom and pop bank. You are not going to say that about the top 5 banks. And I think what this has shown is that it's that middle layer, right? Your small, medium, and large soda at McDonald's. We now know that the medium soda also gets the bailout, not just the large one. And the other thing I think that's important about all this story, to your point, is not only was it Reagan and this is Biden, not only is this on the other side of the global financial crisis, but we also have social media. We also have a different media ecosystem. To everybody that's listening, keep tweeting through it. Right? Keep the pressure on. Don't let people forget the lessons here. Don't let people forget the implications here as quickly. But I want to note, you mentioned also the systemic risk exception. And for those that are unfamiliar, this is a standard applied to a part of the Federal Reserve Act, Section 13.3, that was used extensively in the 08 crisis.
Well, no, this was the FDIC Act. The 13.3 is different.
Oh, sorry. I thought that there was also a systemic risk exemption to a justification for when you can use.
Well, we'll get into that. I mean, this is what I talk about in my piece, that it's similar but doesn't use the same language. And the language goes back to the 30.
Broad-based or something.
Unusual and exigent circumstances.
Right, but I thought that also required 13.3 to be it has to be a generalized thing. It can't be about an individual bank.
Oh, yeah, yeah. So let's back up and we'll take from the top. So there's the systemic risk exemption that's part of the Federal Deposit Insurance Corporation mandate that I believe comes from the same act, the Federal Deposit Insurance Corporation Improvement Act. Then separately, but kind of related issues, there's the Federal Reserve Act. There's this section 13.3, which you can read a lot more about in my piece, which in the since like 1934 or 1935, something like that, has had this provision for unusual and exigent circumstances for lending to individuals, partnerships, businesses, whatever. Basically, just what is often seen as just like an emergency lending in case of break glass. You can kind of do anything. And in 2008, they kind of did anything, and they made individual loans to a whole host of non-bank financial institutions. Dodd-Frank, in part, reformed this, and the reforms that were put in were meant to stop the Federal Reserve ad hoc bailing out or providing liquidity support, however you want to put it, of individual institutions. Instead, they would create broad-based facilities that would support liquidity for areas of the economy. and that was the notion that was put behind it. And what's surprising about this moment in a time when inflation is above target, unemployment is the official unemployment rate's at 3.5%, and you have this situation which is ambiguous on whether it is, a crisis situation, which is usually how unusual and exigent circumstances is read, is whether this would count. And they've decided it's counting, and they launched a facility, the bank term funding program, to respond to this situation using their 13.3 authority. And in a situation where, it's at best very debatable that it is an unusual exigent circumstance, and certainly even if it is an unusual exigent circumstance, it's hard to say that it is emergency in the sense that that 13.3 has usually been thought of.
Yeah, and historically speaking, the way that these kinds of emergency facilities have been theorized and justified and talked about is that you are supposed to lend against good collateral at a haircut. Now, in practice, that doesn't actually happen, but there's usually at least some haircut. There's usually at least some discount that you get your money against. But what we're seeing with this provision that is relatively new is that you are getting money at the face value, at the par value of the instrument. That is to say, no discount at all. So the Fed is basically just saying, bring us assets, whatever the price that you said they were the day before, we'll give you the equivalent amount of cash, and you can use it to shore up your balance sheet. And so on one hand, you've got the FDIC guaranteeing the liability side, and on the other hand, you've got the Fed essentially liquidating the asset side. Now, the initial terms of that facility are only assets that are eligible to be purchased on the open market, which normally means it's limited to government guaranteed instruments, so treasury bonds, government guaranteed mortgage-backed securities, etc. But the door has now been opened to doing this with other assets as well. If they can do it with those, they can do it with anything else for any of their other facilities that go well beyond government guaranteed assets. But the interesting thing about that, to go to our original starting point with this conversation, is that something like a 30-year bond now can be liquidated on demand, can be liquidated into cash right now, directly at the Fed, for pretty close to its face value. If that's the case, and I think you had a good tweet about this, you said, here's a riddle. Is a 30-year bond that you can pledge at the Fed for face value liquidity, does it have a maturity of 30 years, or does it have a maturity of an hour? And so what we have essentially done in order to kind of limit the bleeding of this is we have had the Fed guarantee basically that anybody who might suffer a loss by selling one of these 30-year bonds in terms of interest rate, duration, risk, etc., is not going to experience any of that loss. So the Fed has taken onto its balance sheet any cost, any loss associated with the fact that 30-year bonds and overnight reserves and 3-month T-bills were all considered liquid asset. It has evened the playing field between them in a pretty fundamental way. And the question is sort of, well, what else could we even the playing field here? How else could we do this? And to your earlier point, I think this is where I was thinking about the broad-based requirement. This came out of Dodd-Frank, right? When the Fed used 13.3 authority so expansively in a way that, statutory interpretation scholars say, wow, that was a pretty extreme stretching of the authority. I don't know if it would survive scrutiny under the right-wing court's current major questions doctrine, but it's certainly a useful data point when we are having arguments with people about the $1 trillion coin. They say, you can't interpret that provision that broadly. And my response is, have you heard of 13.3? Have you heard of the talk about putting an elephant into a mouse hole? I mean, it was an elephant-sized hole already, but they got a really, really big elephant, and they managed to put that through a regular-sized elephant hole. And that authority was amended after Dodd-Frank to be narrowed, to narrow the aperture. And the assumption was afterwards that you can't be directed specifically can't be directed at individual entities. It needs to be a broad-based recovery. And so in addition to describing this, to justifying the FDIC's action under the systemic risk exemption, the Fed justified its action under 13.3 on the grounds that they are protecting all uninsured depositors across the banking system, that it is not a single Silicon Valley Bank specific failure. This is a failure across the whole banking system. Everybody's similarly situated, is similarly at risk, and that's why they need to provide this. And interestingly enough, just as we started this, it turns out that First Republic Bank which was the fourth bank on that list, was also based in San Francisco, was just is currently exploring strategic options, including a sale. So even though we managed to stop the kind of immediate bleeding, it seems like some of the repercussions for these other banks beyond Silicon Valley are still rippling out.
Yeah. A few things there. One is on that like maturity point. Obviously, in a certain sense, the Treasury security, whatever, is still on their balance sheet. So it's not, it's not the full way of, well, this had 30-year maturity, but now it has an hour maturity. But in the terms of, well, you need to make payments, it is. You get an amount of money. The bank gets an amount of money in its checking account at the Fed that's equivalent to the value of the bond and equivalent to the face value of the bond, and they can make the payments that they can make. Now they're on the hook if they're on the hook over time to pay back the loan, and if there's a default or something, they're still on the hook for that additional amount of funds. The difference between that, the actual value of the collateral or what, the Fed can get or whatever, and what they pay. But that's a very minute difference. The Fed has often done loans, secured loans against the collateral, where the collateral price was quite general. Collateral price being just like what value you're putting on the collateral. You come to me, you get a loan. It's, a family heirloom, which, I think is worthless, but to be generous to you, I say, that's worth $100 and give you $100 loan. I'm giving you a generous collateral price. And that's the Fed. The Fed in this situation is giving the most generous collateral price that you can have. And there's a lot of circumstances where the Fed makes loans that are non-recourse, which basically means you can hand over the collateral, walk away, no harm, no foul. And essentially a no recourse loan is, where someone can walk away is basically just purchasing without the name, because for example, because you have the legal authority to do a non-recourse loan against certain types of collateral that you wouldn't have the authority to just outright purchase, even under 13.3. And that's, the kind of the logic behind it. But that difference between recourse and non-recourse, that's not the hugest difference in the world. So we really are talking about something that is relatively close to a purchase, and thus, as we've been talking about, collapsing the maturity of that of that security. And the other thing about 13.3 is this is an example where broad-based facilities kind of don't sound that meaningful in a certain sense, because very clearly there's a small set of institutions that this is really targeted to. It's really targeted to like 4 or 5 mid-sized banks, and like possibly there's a certain way which you can simply think that it's targeted at the Santa Clara Bank that is the institution that is inheriting Silicon Valley Bank. It's kind of a liquidity facility that's specifically aimed at that bank to facilitate all these uninsured depositors being covered, and the selling of the not the selling of the assets, the cashing into of the assets at this facility. That's targeting one institution. Now other people are available, but it's targeting one institution. I mean, you kind of think of it like, if you go out in the street and you set up a little stand, and the little stand has to serve anyone who would walk up, but you can make a product that say it's just name tags for Nathan Takis. It's just little artifacts that all have my name on them. Well, technically anyone could buy something with my name on it, but only I would be interested in having some item or some label or whatever with my name on it. And so it's kind of we're seeing it's kind of a dead
but there's 100 people on this.
Okay, maybe that's a bad example.
They're all Nathan Tankers now.
All right. It's Rowan Gray. It's Rowan
I think
Gray.
you can make the case. I think you make the case that it's general. It applies generally to every mid-tier Northern California-based bank that serves the tech industry. I mean, that's an extremely broad category that applies to at least 4 banks, apparently. And to your point about non-recourse loans, I mean, what do you think you're sending a message where someone comes in to get a loan and you say to them, "Here's your loan, and by the way, if you walked away and never come back, we would not chase you." Imagine if somebody says that right when you're signing the loan. What do you think you're getting the message there? By the way, absolutely nothing will come from us if you decide to never come back in this bank or contact us again. I mean, you're basically getting a green light to walk out with the money. So I think this non-recourse, recourse distinction, it is a distinction that matters a lot here to understand when is the Fed allowed to make a grant despite lacking the statutory authority to make grants, when they call it a loan that they never follow up on, right? I mean, this is lawyering fictions 101.
Hey, I mean, the PPP loans, are the forgivable loans are not that far off from just a non-recourse loan.
Yeah, and then the other point about the 30-year bonds and eliminating the maturity here, it's important to note, I think, a lot of us think of a 30-year bond and you're holding on to it, and then you think of a 3-month bond and you think, okay, well, at the end of 3 months, it's gone. But the way that it actually works is you have a 3-month bond in your portfolio, a 3-month bill, in your portfolio, that is a fraction of your overall portfolio that you want to be diversified. So you say, I want a certain amount of this instrument. I want a certain amount of that instrument. That's how I, spread the love around. But when my particular 3-month bill comes to maturity, what do? Do I say, oh, well, that's it. I guess I'm, that part of my portfolio is over? No, you just go out and buy another one. So there is a sense in which there is a thing called a 3-month bill. A particular instrument has a QSIP number. It has like a specific barcode, etc. Then there is this idea of holding space on your balance sheet for a 3-month bill. And the space that you hold on your balance sheet, it can be renewed on an ongoing basis, on a rolling basis, right? Just like people sort of say all the cells in your body die over a period of 7 years. Are you still the same person? 7 years later, there's not a single cell that existed 7 years ago. Well, you can have a 30-year period where every 3 months you're just buying a new 3-month T-bill. And in your mind, right, that's still occupying kind of one slot in your portfolio. And so to flip that around, you have a 30-year bond and you pledge it for collateral, and the duration of the facility is up to 1 year. So you are getting cash against this collateral for up to 1 year. Well, depending on what part of the world you're working in, not the policy world you're working in, 1 year can be an infinity, or the world can change a lot in 1 year. And so what does it actually mean that this is 1 year duration? Well, it means that that's as much as they thought they needed to say right now. Just like the swap lines that the Fed set up were justified as an emergency, and then 10 years later, look, they're still there. Now they're permanent. So you can have a situation where this 30-year bond is being pledged for up to 1 year, but at the end of that, you pledge it again. Then you pledge it again, and then 30 years go by, and at every point in time, you had cash that you could get against it. Well, what does it matter if there's a 30-year maturity? If at any point in time you can be pledging it for short-term cash over and over and over, then the maturity is dead letter. To Stephanie's point in her book, The Deficit Myth, you could call this one form yellow money or one form green money, right? The difference between cash and bonds. But then if you're talking about yellow money, you could say, well, one is sort of marigold yellow and one is sort of, I don't know the other colors of yellow, lemon yellow, whatever, right? They're different variations of yellow, right? And the only question is, does those differences matter? Well, this kind of thing makes them matter a lot less. This kind of facility means that the part that you called 130-year and the other part, you called it 3 months, has very little significance. They might have different processes, they might have different interest rate risks, but they don't have much to do with time anymore. They have to do with what facilities you can pledge them at for different amounts, etc.
Yeah. So I think this is a good spot because we've talked about kind of the discount window. We've talked a lot about collateral. We've talked about bank deposits. I think this is a good point to explicitly talk about your paper, banking in a digital fiat currency regime. Is that what you said? System, whatever. I think this is a good point, and this is something I started really hammering Saturday, which is, in one sense, what's going on in this mini panic crisis, whatever you want to say, is the key thing in your paper, which is the disjuncture between, hey, we give these banks these bank charters, we give them access to all these tools that they can to create deposits and make loans and buy other assets. But these powers that we grant that facilitates that are not, they're not fully reflected in the discount window, in the terms from which you can directly borrow from the Federal Reserve, the amounts, and but specifically the collateral prices, how collateral would be valued. You can buy an asset for whatever you pay. You can get which would be acquisition costs. You can buy an asset using these publicly granted powers, but you can't then pledge that same asset at that price and get a loan that matches that maturity from the Federal Reserve, or at least a loan at all that it doesn't necessarily have to be maturity match, but a full a loan that is a full equivalent value of the asset that you acquired. And from a franchise point of view, from our point of view of this is all fundamentally granted, bound up in public powers, even if there is certain kind of crisis episodes that have happened with bank runs, which are rare and rarer all the time. This is this disjuncture which is a problem in crisis circumstances, and the Fed has to quickly react rather than just use kind of its normal processes, but also kind of obscures and makes complicated what could be kind of more simple and more just kind of on the surface what is going on.
Yeah, I mean, and first of all, thanks for boosting it. It's always nice. I mean, it's a small little paper, and half of it is devoted to a kind of 101 explanation of how banking works. So it was a real kind of sketch. It was a real kind of, I remember, I think it was Borges or someone who used to say, he writes reviews of books he doesn't have the time to write. So it was one of those kinds of papers, but in the sort of world of academia where nothing matters unless you do it first or say it first, and I've had my experience of people taking ideas that I came up with and getting them out there by writing them down poorly before I did. I want to give credit to Sally Omarova, whose article, The People's Ledger, I think is sort of the real fleshed out articulation of this idea. And to the extent that Morgan Ricks and Lev Menon and others talked about Fed accounts, they also mentioned this kind of possibility in the event that there was a large number of people that left the banking system and went into Fed accounts. They said, well, any loss of liquidity that could be offset by the central bank. But to be mildly self-aggrandizing for a second, I wrote my paper about 2015, and those two came out years later. So I do, short and underdeveloped, but still first, and that counts for something. But I think the other thing that I was trying to do with that paper was make a strong form version of that argument, a stronger argument that you made, which is, I don't want this to be something that you tap if necessary. The suggestion wasn't, hey, maybe in the future, if you need liquidity, you could always be able to pledge it. It was, this should be the default. We should move towards a system where we don't have two tiers of deposits, insured deposits and uninsured deposits that are kind of sometimes most of the time insured. That's already incoherent. But also, as we're moving into a digital currency world, we don't need deposits at all. We don't need a two-tier payment system where on one hand there's the central bank money that only the special banks get, or you and I get with paper, but on the other hand there's the bank money that all of the rest of us use in the hoi polloi. We can just fold that into one, and the banks can still do their credit allocation. They can still do the underwriting. Maybe you want that, maybe you don't, but you don't have to decide that to fix the payments layer. So banks are still out there, assessing whether a particular person is a good credit risk or a business in the way that Jim Carrey does in Yes Man. But every time they approve a loan, the money that you as the borrower would get in your pocket would be government-issued digital currency. And the way that accounting would work is you would sign your IOU, give it to the bank, right? They would hold your loan as an asset, but they would immediately be required to pledge it at the central bank. And the central bank would give them a forward, an overdraft, or whatever, a loan of central bank digital currency, which they would then forward on immediately to you. And so the bank itself would be left with a liability to the central bank and an asset that they had pledged at the central bank. The liability would be your loan. If your loan goes under, then they have a problem that they have to deal with the central bank. But in the meantime, all of us with the actual cash in the economy has nothing to do with that process, other than that we authorize that bank to make an advance on behalf of the government. And that's where this sort of whole process, this suggestion, refocuses attention to the process of making the loan. At the point the bank approved the loan, it created deposits. Those deposits are backstopped by the government. If we want to say that was a bad decision, the time to address that was when we gave the bank the authority to approve the loan, not later on and saying, well, how could you have done that? What could you possibly been thinking, or creating this fiction that the uninsured depositors should have been supervising all of this stuff and watching from a distance, and that it's their fault that they didn't catch, cracks emerging in the dam of the quality of the loans as they were being made. It has the secondary benefit of limiting the way that those bank loans can then be repackaged and sent out into the private financial system, which, for some people is a strength, and I think it's a negative. But what it would mean is if that loan asset is pledged at the central bank, it can't be securitized. It can't be rehypothecated. It can't be originated with the intent to immediately sell it to some other bank, right? The minute you make that loan, it exists locked up as collateral at the Fed. And that would be a very boring, simple, vanilla vision of commercial banking, where it's essentially a hub and spoke system, right? The central bank is the hub and each individual commercial bank is a spoke that is then feeding loans and digital dollars out to all the customers, to all the people out there. But that the loans would simply be in a bilateral relationship between you and the bank and between the bank and the Fed. Those would be the only two kinds of dynamics we need to set up, and everything else would be very boring. So it has a kind of radical simplifying effect on the structure of the banking system and the way that liquidity gets generated in the private markets, etc. But the other kind of underlying context, which we didn't mention, just want to mention quickly, is the reason I even wrote this back in 2015 was that I was going to meetings with central bankers around the world and others about central bank digital currency before it kind of exploded into the public consciousness after Facebook's Libra, now Diem, in 2019. And the concern at that time was not that a government digital currency would fail, it's that it would work too well. Is that it would work so well that everybody would leave the banking system and pack up and move all their money into a Fed account or something like a Fed account or whatever it would be. And so the concern was banks would suddenly be facing a massive liquidity crunch, right? What we are seeing with Silicon Valley would be dwarfed in comparison to the kind of liquidity outflow we might see on a sustained basis if we had a functioning Fed account system. And the central bankers were terrified of this, mostly because it's disruptive and partially because all the banks are terrified of it. And when they call the Fed and the central banks take it seriously. So what we had in response was this kind of walking back, a kind of like immediate apology for innovation, where the central bankers were saying, don't worry, we'll make sure that any central bank digital currency we issue will not cause a huge depositor outflow. They validated the problem and immediately went to minimize the solution. They said, we'll make sure we don't pay interest on it so it's not as attractive. Or we'll put caps on individual people's accounts so they can't put all their money over, et cetera, et cetera, et cetera. But the effect of that was to make the innovation of the digital currency itself kind of dead on arrival. You've watered it down so much, it's actually not that different from the status quo. So why would anybody be excited by it? So the point of this paper was to essentially embrace the idea of depositor outflow, saying it's not a bug, it's a feature. It's not a problem, it's the goal, is to get everybody out of the banking deposit system into a standard layer that works for everybody. And if the way we need to do that is the central bank to provide a shit ton of liquidity against any assets, so be it. Well, what is this crisis right now response look like? It looks like the Fed providing a shit ton of liquidity against the bank's assets so that it can accommodate a massive depositor outflow. It doesn't have anything to do with digital currency yet, but the implications are that this model works to address this particular problem.
Yeah. And I think that's the key. We want to lean into the outflow. We don't see the outflow as a problem. We see the outflow as kind of revealing what was already true, but it's just making a fully consistent system where it's not, the crisis happens and then, Federal Reserve lawyers have to stay up, on weekends and have work 16-hour days to essentially do all these big and small things to expand the discount window, expand the collateral schedule, the list of, what can be accepted for collateral and at what prices, and at what terms and at what maturities. Instead, set up a system where rain or sunshine, it works that way. And then things are kind of normal. They're just normal. There's no outflow to be worried about because it already happened, and there's always liquidity backing always already happening to deal with it. And as I said, what's interesting about this moment, what's so fascinating is there's kind of like a convergence of views about this. When, if you had asked us a week ago, we would have said, we think our view is coherent, and and of course we believe our own view. We think we're right, but we would say it's an extreme minority view. And now it's a lot less of a minority view, maybe not in full, but in large parts. A week later, after this event, I was reading the recent New York Times piece about it, called, "Was this a bailout? Skeptics descend on Silicon Valley Bank response." And I was really surprised to read this quote from William English, who was a former director in the Monetary Affairs Division at the Federal Reserve. He's now like a Yale professor or Yale research scholar or whatever. And he kind of summarized the point about uninsured depositors, I think, like perfectly, And he first of all, he said that this episode illustrates that a system of partial deposit insurance doesn't really work, which is, what we've been talking about a while. And then they have this quote from him, which is pretty amazing. It says, "Market discipline doesn't really happen until it's too late, and then it's too sharp. But if you don't have that, what is limiting the risk-taking of banks?" And it's exactly, uninsured depositors don't really discipline banks. And then, then it's revealed that there is some sort of fundamental underlying problem, or people believe that there's some fundamental underlying problem. And then all the depositors, leave at once. There's this huge sudden outflow. And, banks that are heavily relying on uninsured depositors have these huge problems, but it's not actually doing anything to regulate the behavior of these banks in the way that it's, supposed to. But on the other hand, you need another part of that system. If we're going to fully acknowledge that, hey, every loan that a bank is making is being backed by the government, and this is going to be reflected by that loan is going to be pledged as collateral at its acquisition price, at its face value, at the Fed, then we need to have much stronger sense of a much tighter regulation of what those assets are, what the qualities of those assets are, but also their quantities, because their quantities have an impact. This credit creation is financing activities. Well, the financing of those activities have macroeconomic implications. So, this was where there's kind of like a handoff between your piece and then the report that I put out early last year.
Yeah, let us get to that. I want to make now I was self-aggrandizing for a second, so I want to make some shout outs along the way, which is first of all, Daniela Gabor, her work around shadow money, basically saying that in the new world, obviously banks can create deposits when they make loans, but beyond that, in the capital markets, any actor that can get collateral turned into liquidity, whether it's at the central bank window or through a dealer market or something, is able to create shadow money. So the relevant question is the sort of liquidity and haircut prices of collateral. And I think what we're seeing now is the recognition that really happens at the policy level, and is the kind of end goal of where we're moving. Is the only real question is anyone that creates collateral, can they get it turned into money on demand, and at what price? And so, from her point of view, okay, unlimited deposit insurance, that's well and good and interesting. But it's in fact the decision by the Fed to accept all of this collateral without a haircut that is the far more radical systemic implication. And one of the things after I wrote that paper, and I was actually speaking to her, and she said, "Oh, that reminds me of Mervyn King's and what the Bank of England is doing with pre-positioning accounts." And Mervyn King wrote some of this in his book, The End of Alchemy. But the Bank of England for the last number of years has been doing this thing they call pre-positioning, which is essentially banks coming to the Bank of England and saying, "We've got these assets. if there was a crisis and we had to pledge them for liquidity, what price would you give us? And the bank does the assessment in advance, right? Ex ante, right? Making hay while the sun shines. And they say, well, we'll probably give this price. And they say, okay. Now, I don't actually know, I haven't looked into it too much detail, what the legal treatment thereafter is of those prices. But I would call whatever price that is the only legally significant price of those assets when it comes to risk assessment, right? What this new facility at the Fed is doing is saying it's 100% of the acquisition price. Good for me, right? But whatever that number is the number that asset in a fire sale has a benchmark that it won't fall below. So I think it's actually, if we're looking for where this could go, that's a direction that it could go. Another person to shout out here is Warren Mosler, who said, that the liability side of banking is a poor place to impose market discipline, right? He's been talking about unlimited deposit insurance for a very long time. And the other kind of MMT forefather that has been talking about a number of these things is Hyman Minsky, who said for a long time that the place that we should be focusing on is not waiting till a moment of crisis and then working out who to bail out, but looking at the assets that we allow banks to acquire and lend and things on the way up. And the way to do that was extensive use of the discount window. But of course, the discount window is stigmatized, which is the dumbest thing I've ever heard. If there's ever an industry that should be ruthlessly opposed to implicit norms, I would assume it was the banking industry. And yet the soft stigma around the discount window still seems to be enough to keep people away. I feel like whoever's the first banker that creates a bank model that explicitly takes advantage of the discount window without any shame should make a hell of a lot of money, frankly. But what we are seeing now with this bank funding term funding facility is essentially a discount window by another name. I kind of joke it's the discount window goes into the bushes and emerges with a mustache, and it's the Schmishmat window, and then apparently we're all allowed to use it. So Stephanie called it not a bailout but a bail-in, right? The uninsured depositors are bailed into the insured deposits, right? There's a sense in which we're bailing these risky assets into a less risky category by providing generous collateral lending terms for them. And I think this all goes to kind of the bigger picture here, which is Morgan Rix's point in his book, The Money Problem, which is there's all these kinds of money that we let come into existence that have different properties, right? Yes, there's cash, there's central bank reserves, there's insured bank deposits, but there's also uninsured deposits. There's also short-term treasuries. There's also money market funds, right? There's also e-money balances, et cetera, et cetera. And as Dan Oy has written, some of them is bad money. It doesn't have as good credit properties. It doesn't have as wide, payments system interoperability properties, et cetera. So getting to a point where we can identify a set of properties and say anything that is in this category should be sort of homogenized and standardized, right? Like the 1800s banknotes that were all different, and then we now have the greenback. We should be looking to create one common, checking account instrument and one common liquidity facility. And I think this has pushed us a lot closer to that world.
Yeah. I think that's absolutely the case. And as to pick up, that's what the other component of this is, treating the assets on the asset side a lot more seriously and having direct credit regulation on those assets, the quality of those assets, and so on. And one of those, which kind of gets to your shadow money point, is some of those assets, some of those lines of credit, and so on, are in themselves loan support to these shadow monies. There's, you mentioned Saleh Almirova, her big work in 2010, which is so important to this, in the ways in which a lot of the shadow money, of what we think of as shadow money, was money that was issued by entities that were within a bank holding company. So they weren't the banking subsidiary, but they were the other parts of the company. And we used to have rules that try to silo banking subsidiaries from the rest of the entities. And the Federal Reserve gave various exemptions to the biggest banks over the 2000s, essentially providing liquidity support from the banking subsidiary and letting funds be transferred out of the banking subsidiary to other subsidiaries within a bank holding company. But also, there are all sorts of banks that provide support to financial institutions and effectively facilitate them in turn issuing their own kind of quote unquote shadow monies. And obviously this happens with repurchase agreements, where there is the idea that you have this collateral, which is a treasury security, which is very safe, and but if you're accepting that as quote unquote collateral, there's also this concomitant liability, the liability to repurchase the collateral at a higher price, and you're treating that liability as like a form of money essentially. It's not money you can directly pay someone else with, but you'll get it back real quick, right in a second, at the end of the maturity of the repurchase agreement. So there's all sorts of these ways in which, and the phrase I used in the report that we put out, the Public Money Action put out, is sub-franchising. There's all sorts of ways where liquidity that is franchised in a sense to chartered banks is then sub-franchised throughout, even within a bank holding company, but even just other entities. And when you tie certain kinds of asset regulations on that kind of lending, well, that's going to be a squeeze on liquidity in funding markets, which essentially the liquidity that is going to support all of these shadow monies. And you have to have a system for that. And so there's, when you start pulling the thread of this, it seems like when you start at the surface, we're talking about something very simple. I mean, at first we just talked about, hey, we're going from a system of partial deposit insurance to full deposit insurance. But when you pull the thread, if you go the full way of having a kind of fully coherent alternative system, and obviously, big doubts whether we'll actually really pull that thread, although we're pushing as hard as we can, it spirals out into all these different implications. And there's a whole question of shadow money that gets tied up into this, and shadow banking, and in the way that the whole wider financial system is structured around the kind of the laxness the relative laxness that still exists on the banking, on the asset side of chartered banks.
Yeah, I mean, whether it ends up happening or not, it's still our job to actually think through it so that 5 years later our colleagues can say, oh, that makes sense. There's never time to do it right, but there's always time to do it again. And to your point, I was sort of thinking as you were speaking about the sub-franchising, it's sort of like that meme of Moe kicking Barney out of the bar in The Simpsons, and then he turns around and Barney's back in the bar. Like the Glass-Steagall separation of deposit, in commercial banking and investment banking. Well, you set that up, and then you turn around, and when you get back, what do you see? You see commercial banks finding ways to create 1,500 different relationships to other parts of the financial sector to ensure that their liquidity trickles out. And so that the implicit government support behind that liquidity also trickles out. So whether or not you have a Glass-Steagall separation at the entity level is sort of less important than whether you have an actual perimeter around the safety of money and liquidity. That clearly hasn't been the case, and wasn't the case whether it's the Eurodollar market, the money market fund industry, the repo markets, or anything else. But the other example that I was thinking about when you were talking was the central bank swap line system, where the original group, and I was sort of making fun of Switzerland earlier, the original group of the C6, Perry Merling said, I think a few years back, stop, who cares about the G8, now the G7, who cares about the G7? Look at the C6, which is the 6 central bank actors that created a swap line agreement between each other to essentially provide each other unlimited of their currency against the others at whatever interest rate, so that in that situation, it wasn't the asset price, it wasn't the collateral price that was at risk, it was the exchange rate, right? You had a system that had been a floating exchange rate, and now it's a kind of dirty float. It floats within policy bounds that say in a crisis we'll step in and backstop this exchange rate so that it doesn't go further, and so that banks in other countries can get access to the local currency here that they need to make payments and things. But when they set up that C6, it was the US, the UK, Canada, Japan, the European Central Bank, and Switzerland, right? One of these is not like the others, as the old song goes, But then once that was in place, each of those actors turned around and started building their own swap line relationships regionally. So you have Japan with swap line relationships with South Korea and the Philippines, and where Europe doing it with countries that are not in the Eurozone, etc. And so you end up having this system where on one hand, the United States says, well, okay, we'll do an arrangement with just you. We'll let you have access to our credit card, just you or our money or whatever it is, just you, just our friends. And then it turns out they're all sharing your Netflix password with everybody else too. And suddenly everybody in town is using your Netflix account. So this sub-franchising is a common dynamic across a hierarchical and nested monetary system, right? Money is a hierarchy. But maybe it's worth just sort of clarifying explicitly what you're looking at with that report, which was an attempt, to sort of introduce it briefly, an attempt to say in 2020, that looks like we're actually going to get some real spending, hopefully. We're talking about the Green New Deal and all that kind of stuff. Well, what if we actually finally find ourselves on the other side of this long demand drought where underinvestment and insufficient purchasing power has been the defining feature of the era for decades? What if we finally get to the other side of that and we're dealing with a genuinely hot economy? How can we start making trade-offs between public spending and private investment to the extent that private investment can be competing for real resources, right? You want to build a school in a town, you want to build a casino in the town, the public investment, the public money going to the school, and a private credit to build the casino is different, but they're both trying to, hire the same construction company and use the same bricks and the same concrete. And so how can we have a system that can allow us to turn down the dials, right? In the same way as we talk about the possibility of using tax increases and things to reduce fiscal the demand via fiscal policy. How could we reduce overall real resource claims in the private credit and investment markets without the mechanical interest rate that we currently use? If we go beyond the neoclassical idea that all we need is one interest rate, like Paul Krugman says, right? One interest rate or Borealis. What can we do if we don't do that? And what does the sort of policy framework look like? So do you maybe want to explain what what you're arguing there for people?
Yeah. So essentially, and this kind of gets us a little, even more far afield, but it ultimately is relevant of, that there's these, there's all sorts of, activities that we want to finance. There's all sorts of, projects that we want to devote physical resources to, labor, and so on. And you potentially easily see in a situation with a huge fiscal program that you run up to the potential constraint of expanding incomes in the economy, expanding spending in the economy, where you start running up to shortages in various sectors. So you want to come up with some sort of offset, and obviously the most traditional offset is taxes. You can offset certain types of spending with taxes. Now it doesn't work the same way the traditional system works. You have to figure out whether a tax will actually drain income from the economy, drain spending in the economy. Certain types of taxes don't really drain income, don't really drain spending. They might serve other purposes. They might be useful in other ways, but they're not necessarily useful or as useful, quote unquote, dollar for dollar, in that respect. There's certain entities that you can tax where $1 of revenue collected, you only reduce spending by some fraction of that dollar. So you need to, tax $8 or $5 or whatever it is to drain $1 spending. And it's not necessarily, the type of spending targeted where you need, where you need to free up resources. So you got to think through those things. But the second piece is that when you think about it in demand terms, there all is what the phrase I coined was non-fiscal pay-fors. There are pay-fors you can have that are non-fiscal. I kind of, and in this context, it's, monetary policy pay-fors. It's, reducing demand through exactly the kind of we're talking about, tighter direct regulation on the assets that banks can acquire, essentially by creating money. An obvious one, which became very relevant in the pandemic, which is certain types of non-financial regulations. One way you can think about the pandemic, that initial period where demand was sucked out of the economy, is that health regulations for very good reasons, shut down various businesses and drain demand from the economy as it was doing. Now, obviously, there were all sorts of knock-on effects. I'm not going to get into a whole discussion of the macroeconomics of COVID, but nonetheless, you can see how tools that aren't spending, that aren't taxes, that aren't raising interest rates, or which I'll get to, or cutting spending, can have big demand impacts. And with COVID, you needed big fiscal programs to offset what was going on with COVID, but you can look about it the other way around. You can search for the kind of regulations, whether financial or non-financial, that will offset spending of big programs. Obvious thing to pair with the Green New Deal is certain types of environmental regulations, which drain demand. Anyway, that's a whole other big topic, but where can kind of wrap it up with this. Remember where we all started with this. I think we haven't talked about interest rate risk in like at least an hour. So we'll bring this back full circle to that, which is there are only unrealized losses that were large enough to hurt Silicon Valley Bank because interest rates had risen a lot. Now, they didn't manage that interest rate risk well, but interest rate risk wouldn't necessarily be a thing for a chartered bank if the Federal Reserve wasn't raising interest rates. And where this all gets to is, okay, if we recognize that this money creation power is being franchised, we recognize that discipline from uninsured depositors is a crock, that asset side regulations have to do the job, and that our regulations, even post Dodd-Frank, don't reflect the idea that this is a public franchise and the kind of oversight regulation that you would want of something that is essentially this grant of public power, this franchise, is, well, you would tighten credit regulation, you would tighten asset regulation, you would tighten you have direct credit regulation qualitatively but also quantitatively on the banking system. But this connects up with macroeconomics because that has a macroeconomic effect that will drain demand from the economy. So even if you agree, and obviously there's a huge debate over how much we've needed the Fed to drain demand from the economy, financial regulation, direct credit regulation could have done that job. And in the world where that was doing that job, first of all, we would have, you would involve really overhauling our financial regulatory apparatus, and that would help to avoid kind of these very obvious safety and soundness issues. But also, we wouldn't be raising interest rates, so there wouldn't be a whole bunch of unrealized losses that you have to worry about in the first place. So there's a way in which this all comes full circle to, regulating banking the way that it should be, in recognizing that, the regulation provided by uninsured depositors is a crock, so we need to be regulated, it provides a profoundly different way of looking at managing financial conditions, of tightening financial conditions, quote unquote, in order to drain demand from the economy. And so it's not the full thing. There are all sorts of things about supply chains, talking about another thing, but there's a way in which this whole episode has illustrated both the problem with our current financial regulatory apparatus and how solving that problem can also be a huge improvement to the way that we deal with interest rates and interest rate policy.
Yeah, and I think we can probably wrap it up now. I'll end with one other, sort of bringing it back to where we started, which is the biggest objection, right? Whether it's Isabella Kaminska or others, the biggest objection to what we propose when we say don't use interest rates is it's sort of like people saying cap and trade is too micromanaging compared to a carbon tax, right? That the single broad-based interest rate, sure, it has contradictory effects in the sense that increasing the cost of credit on one hand is at least partially offset by the fact that you're increasing interest income, which is another thing that Warren Mosler's been talking about a lot, that there's been hundreds of billions of dollars of increased interest income since the Fed started raising rates. It's its own form of fiscal subsidy or stimulus right at a time when you're trying to constrain demand, although admittedly not necessarily one for one with any other kind of effects of the rise in interest rates. So not only do you have the sort of broad-based thing, but also it requires you to sort of pick winners or losers. You're picking which credit you like, whether it's saying this industry, not that industry, or saying you can only make X amount of loans versus someone else. It is fundamentally challenging the idea that anytime a bank sees a profitable loan, they should be entitled to extend new purchasing power and new money into the economy to finance that. And the argument, you can put it crudely, and I've heard journalists and others who are otherwise sympathetic to MMT and other of our ideas get very dismissive, saying, this is essentially communism, this is essentially state management of the economy, this is Gosbank from the Soviet Union, you're going to be kind of having some government policymaker let me know whether I can get a mortgage, this is unreasonable. And the question is, well, how different is it actually from our current system? How different is it actually from a system when everything goes wrong, the central bank or somebody comes up with a list of assets and a price at which they will lend money against it, and that is the way that they selectively bail out or bail in different actors. So if you want to think the Fed isn't picking winners or losers right now, it's not doing it individually. It's not by your name. It's by your asset category or by your institutional structure. Go look at the collateral schedule at the discount window, right? Look at the terms of all of these lending facilities. This is straight up picking winners or losers. And this maybe time to end by plugging your book, Nathan. But this is exactly the ideological and political risk that they accuse us of being responsible for advocating. Whereas, in fact, what we are saying is this is the way the system already works. This has always been the way the system already works. We were always providing liquidity against assets for a certain price, and we were always implicitly guaranteeing any instrument that gains sufficiently wide circulation to be considered money. Those two narratives are ones that are hard for some people to swallow. They're hard for some people to admit to themselves, and certainly to admit on paper in the policy world. But it is, in fact, what is happening. The acidic realism which we try to bring to this stuff is stop lying to yourself and everybody that isn't already the case. And this crisis has, I think, done our job for us on that front. It is thrown a bucket of acid over the delusion. Yeah.
There are all sorts of people who I think, like this guy, William English, who I'm sure a month ago, Kaminsky or someone else could get on the phone and give a rant about how our thing is communism, and they would, or give a rant about the kind of proposals that we're talking about. Who now, in staring in the face of truly having unlimited deposit insurance, are going, well, no, clearly, giving unlimited deposit insurance to banks is picking winners and losers, because you're letting the banks, go wild, go doing whatever they want. There's a certain way in which unlimited deposit insurance, but you're tightening regulation on the asset side is kind of limiting or shrinking the intervention that you are creating by chartering banks in the first place. I plan to write about a piece about this specifically, and so I'll try out my kind of analogy that I'm working on before we finish up, which is, one way to look at a certain policy. You can have a policy where no one ever charged this guy with for committing murder. No one will ever prosecute him for committing murder. But if you kill him, even if it's, in factually self-defense, we'll charge you with committing murder. So, he has the protection of the legal system, but you don't. There's no threat of this guy getting prosecuted or something happening from to kill someone. One way to frame that is, well, that's non-interventionist. We're enforcing the law less. We're enforcing the law less. So, this is actually intervening less and, trying to direct this guy's activities, or, limiting directing, who he's going to kill and who he's not going to kill. Well, that's picking winners and losers. The other way to look at it is that person has been granted a license to kill. And if you're granting someone a license to kill, then there should very least be regulation on that concomitantly. So, and that's the kind of, you can look at it either way. It's when you stare too closely, it becomes incoherent. Is giving someone the power to create money and then acquire, billions and billions of dollars in assets, is that the intervention? Or is, setting stronger and stronger ground rules on them doing that the intervention? It's kind of, the answer is neither, because it's not a question that makes sense. There's no question of intervention or not intervention. There's just the policy design choices that you're making. And, I think a lot of people think that with everything with too big to fail banks and the largest banks and the way that they've been able to operate is an intervention, is something that has been government backed and profoundly shaped our life. I mean, these are huge institutions that make literally $1 trillion decisions. How can we say that, like, having even stronger rules or saying, hey, you can't make as many loans as you were before, is the interventionist part rather than the non-interventionist part?
You see this with libertarian theory all the time. Oh, taxes, they're so interventionist. Well, the property rights were pretty interventionist for the people that were living there before the colonizers came or something. So the question of whether the chicken or the egg is the intervention, it's sort of an ideological question. And, in addition to just the strength of the intervention, we're also talking about how explicit it is, right? There's never time to do it right. There's always time to do it again. But it's also, if you know you're going to do it again, if you admit that you're going to do it again, then you actually have to have an explicit guidance that you can be held accountable for. If you keep telling yourself this is the last time you're going to get drunk, and then the next day you wake up blackout in a park, and you're like, well, how did I do that? Like, at a certain point, you are actually not taking responsibility for the behaviors that are causing you to keep doing that every week. So what is it that we are suggesting? We're suggesting making explicit what's implicit. Making explicit that uninsured deposits are going to get bailed out at a systemic level, even if individual tiny banks get to fail every now and again just to keep people on their toes. What does it mean when we are going to say explicitly, these are the assets that you are going to be able to get liquidity against at this price? And we will talk about that when you come in the front door, not later on when everything goes to shit. Our view is it's going to make for a more informed electorate, it's going to make for more conscious policy making, and it's going to take that combination of sort of anxious self-delusion and straight up ideological obscurantism that is currently defining our debate out. And our view is that's going to lead to a better class of policy making, or at least one where there's more voices and people able to know what's going on who don't have years and years of slowly going insane, getting this depth into the financial system to actually understand it.
Yeah. And on that note, I think, we're right at the 2-hour mark of when we figured out all the technical issues and started talking. So I think this is a good place to start. Obviously, we went longer than I think we were expecting to go, and we didn't do a Q&A. But we'll definitely be doing more of this regularly. And I think, we'll figure out more of the structure of this as we're going on. But I feel like this is a very successful thing. Obviously, that's for the audience to judge. A recording of this, I think we'll definitely be posting. And and I think this is a good place to stop. And I think we'll probably have to do a follow-up even just on the Silicon Valley Bank stuff, because there's definitely more to say about that.
Yeah, right. Well, thanks for doing it. Thanks for the invite. And I guess thanks Elon Musk, for
All right.
Thanks,
Bye.
everyone. Take it easy.